are there any kind of top tips in terms of being able to manage your incomings and outgoings?
Yeah, I think as a typical accountant,
keep yourself an emergency fund, a rainy day fund. That's always really important. If you've got...
What strategies are you three employing when it comes to servicing your mortgages, and do you feel that's the right strategy? Good morning, everybody, and welcome to the True Potential Do More With Your Money podcast. It is the 12th of November and it is episode 94, and today I'm delighted to be joined by Laura Robinson, by Neil Rayner and by Jeff Casson. And today, ladies and gentlemen, we're going to speak about debts, loans and mortgages. We're going to speak about the good side of debt. We're going to speak about the bad side of debt. We're also going to share some good and bad practice when it comes to managing the debt and how we balance that against also manage our investment future. Before we do that though, Jeff, maybe if you wouldn't mind kicking things off with the customary markets update, please.
Yep, I suppose I'll just build on a little bit of the themes that we've been talking about in morning markets over the course of the week, and probably similar themes that we've been discussing over the past couple of months indeed around inflation. This week we had inflation from a number of economies, particularly the US, where we saw inflation move up to 6.2% on an annualised basis, which is the highest it's been in around 30 years. We can look back at that and think about what's driving that. Well, we know that energy prices, food costs, the supply chain bottlenecks that we've been talking about there are really biting and causing that inflation rate to move up. Similarly, we're seeing that in other economies, Germany up to 4.5%, so much higher than central banks would want it to be. We've started to see some of that reaction coming through. We know that the Federal Reserve are going to step back in November towards the end of this month in terms of the support they're providing. I think the other thing that we touched on over the course of last week was really the volatility in the bond market. Equity markets just continue to move up. We had a little bit of a wobble on Tuesday and Wednesday of this week, particularly in the US, in reaction to that inflation number. But in essence, markets have continued to move on. Yeah. Look at the UK FTSE 100, back above its pre-COVID level for the first time yesterday. Yeah. Good company results, but really weak sterling as well. And that's a big beneficiary for the FTSE 100 because of the export-oriented nature of those businesses. So it is a bit of a conundrum with sterling, back to 133.6 from where it had been at the beginning of the year. So we've wiped out effectively the year's gains against the dollar, for example, back to that low level. I think just the other real thing around it is just looking at UK GDP number as well that we had yesterday. Bit disappointing for some, but actually you dig down into it, quite nice improvement month on month. So July and August weak for the obvious reasons. We could see it in the office here, the pandemic, people out of the office, not able to work. That was the same across lots of manufacturing businesses as well. So it's not surprising that GDP was weak, but then a recovery into September. So be good to see that continuing to work its way through. And then the other thing has been company results across the piece, which have been, I think, really interesting to sort of dig into some of the themes that we've been discussing, supply chain bottlenecks, how that's impacting. It's not really impacting businesses that much. They're still reporting really strong margin performance, strong earnings growth, particularly in the US. Interesting snippet from two auto companies. We know they're the ones that have been most impacted by semiconductor shortages. Both Ford and then GM last night talking about starting to see some of those challenges abating into the back end of this year, but more importantly into next year. So supply chains starting to respond to those challenges. So in the main, equity markets marginally higher. If we look at that, US slightly weaker, Europe, the UK moving on, bond markets moving out again from moving in last week, and sterling weaker.
And you mentioned obviously the volatile bond markets, you mentioned inflation as well. Just for me, but also for everybody listening at home, does that have an effect then on interest rates?
It has an effect on, I suppose, in two ways. One, certainly central banks have, in the main, a dual mandate, which is to think about employment, but also to think about price stability. So price stability is very much attributed to the inflation dynamic, and that's why we're seeing the volatility coming through. because if we look back 3-6 months ago, it was very much thought of this word transitory. Now, what that means, there's no defined time of what transitory is. Transitory could be 1 month, it could be 18 months, but really it was thought, I think, then that these spikes that we were seeing were a 3-month, 6-month reopening issue. What we've gradually seen and as it has evolved is that inflation dynamic has just continued to roll through from different sectors, and that's impacting on inflation expectations, which influences then how the bond market reacts. The bond market's driven by the inflation and the interest rates.
Yeah.
So there's the effect of, well, how to counter inflation, we move up interest rates. Add into the mix at this point in time, we've got all of the support that came in last year from a fiscal perspective, pushing in on a demand side. So we've seen a really strong demand recovery. So demand is driving that inflation level up. Central banks have to react initially by taking the support out, but then also thinking about rate moves. And that's why we got the real volatility last week, because the Bank of England had been expected to move rates. And I suppose this is the beauty of markets. They're discounting mechanisms. They look to price forward those expectations. So the UK gilt market had priced an interest rate increase last week from the central bank. When that didn't come through, big surprise, we saw sterling weakening, we saw gilt sell off. Then this week, a little bit more stability as people started to reappraise that. Again, then go to Wednesday, we get the 6.2 from the US. The US bond market reacts to that. And it's one of these real challenges for central banks, because policy changes don't impact straight away. So if the interest rate goes up tomorrow or next week or whatever, it doesn't impact the economy to 6, 12, 18 months further out. And that's the real challenge for them at this point in time.
Yeah. How do you guess what's going to go on?
What's going to happen? And that's the challenge with forecasting. But why, when you think about why we don't try and forecast, why you want to think about how do you position portfolios to be resilient in those different scenarios, so using different asset classes to allow you to achieve that. So thinking about where you want to be in bond markets, where you want to be in equity markets, etc.
What's the asset classes, Jeff, absolutely right, and probably the geography as well. I guess you just talked about inflation being so high in the US, it's high in the UK, but not as high as that. It's pretty different elsewhere.
And it feeds into how people think about currencies trade off interest rate differentials effectively. So that's one key part. If a currency, and that's why you could argue that sterling has weakened off, because you don't have that same expectation of rate increases, but you've got rate increases potentially to come through, but influencing growth. And there's a lot of dynamics at play in terms of UK GDP growth into next year. There's also the aspect of just how central banks want to communicate it. And you would argue that last week the UK Bank of England did a pretty poor job of communication with market. US, slightly better job. But then, is that their job to guide markets?
No, well, it depends. Certainly over the last few years it is. But I suppose the reason I'd asked about interest was it segues nicely into today's subject about the debt side of things. And Neil, maybe if we kick off with yourselves, when we think about debt, I jotted down in my book some of the predominant types of debt. I guess you could have mortgages, car purchases, credit cards.
Yeah, they're the popular ones. They've all got variable rates, so probably as most people, if they're short of cash, they'll stick some money onto a credit card. Be that it whatever percent, 17, 18%. A lot of people get into particular debt that way. You've got personal loans, which tend to be a lower rate because they're over a rate of time. So I mean, if you look at the current loan rate at the moment, say between £5,000 and £7,500, you're looking at probably about 3%, 3.3%. I think Tesco do something like 3%. So it's easy to borrow. We all see the horror stories about Wonga. And high percentages of debt that way from a short-term point of view. But there's variable options. I mean, people have loans at the moment, and debt at the moment is probably so achievable to go out and get one that it can put people in a lot of difficulty from a financial circumstances point of view.
So that's some of the traditional ones. And Laura, Neil obviously mentioned Wonga. You've probably got other ones such as Klarna and things.
Yeah, absolutely. I mean, very readily available, aren't they? You go on your high street websites, and before it used to be a debit card, credit card, and now it's the likes of Klarna, buy now and pay over 3 months, 6 months, or whatever it is, and also store cards. Store cards are very readily available as well. It's very easy for people to kind of fall into the spiral of continual impulse spending and kind of increasing that debt over time.
I think what we've seen a shift from debt being available for smaller things. So, Klarna is available for someone like ASOS. So if you go onto ASOS, you can buy with your debit card, or you can pay via Klarna via 3 payments. And you're talking, typically with ASOS, you're talking clothes. Traditionally, you used to borrow for a house, a car, or a bigger purchase, something that you didn't have the money in the bank for, and that you realistically had to borrow and then pay it off over a certain amount of time. Now, probably from a more dangerous consumer point of view, you've got things like Klarna, where people are actually going on and saying, I want that suit. I don't have the money at this moment. Let's pay over 6 months. And the danger behind that is, obviously, if you miss those payments, the APRs are horrendous, quite extortionate.
Well, you made a good point there, Neil, as well, about where maybe debt shouldn't have its place in a normal consumer, but you used to work in a compliance position here at True Potential, so I know firsthand some of the dealings you've had to have. And it's far easier and quicker for a member of the UK public to get into debt than it is to save into an ISA.
Correct, and I think if you look at good financial planning and how you would approach it with a client would be, it all boils down to just simple budgeting. What you've got coming in every month from a wage point of view, and what you've got going out, and what you can afford, which we call NDI, net disposable income. If you've not got that money, if you've got, say, £400 spare per month and you want to buy something which is £1,000, just save up over 3 months. Don't get it on any form of credit, because if you can't afford it at that time, then I'm sure you can afford it in 3 months' time when you save up.
Well, we'll get on to net disposable income again a little bit later, Neil, because I think it's really important to get the balance of that right when we look at some other product. But when it maybe comes to balancing that out, Laura, I will lean on you as your accountancy background. Are there any kind of top tips in terms of being able to manage your incomings and outgoings?
Yeah, I think as a typical accountant, I have a spreadsheet.
Yeah.
Of course, that was predictable. So every month, your income comes in, you look at your outgoings. What are your mortgage, what are the first things that you have to pay out? So you've got your mortgage, your various utilities, things like that, phone bills and etc. Then I generally tend to look at what have I got left, how much should I save this month, how much have I got to pay off credit cards and things like that. And then, I kind of manage it that way. And I think debt can be seen as bad, but it can also be good as well. Like you're saying, loans and for mortgages and cars and things like that. But also for those bigger purchases, for example, a holiday or, maybe something that happens to the house and you need that money straight away. I'm actually quite a fan of the 0% credit card. I think for emergencies it's really helpful. So if I've got balances on a 0% credit card, you can very readily available. You can get 0% rates for say 18 months, 24 months, so that you can pay off that large unexpected expense maybe over a period of time. But what I do is, again, kind of on my spreadsheets, I'm in control because I know when, say, rates are ending. So if I've got a 0% and I've still got maybe a balance that I haven't paid off, then I would look elsewhere to then move it to another 0%, because it's very dangerous if people get into that habit and think, it's 0%, it's fine. As soon as that kind of initial period ends, you could be talking 20-25% interest very quickly. So it's almost being on top of you kind of, if you do have debt, and manage it effectively. And what works for you?
I think that's one of the things we've talked about a lot. It's about having knowledge. It's about going off and understanding what you're actually getting. So whilst it might look really good at a headline level, think about, well, what does that small print say? And there's usually quite a frightening number that might be down there.
Some big numbers.
And that is going to erode your wealth. You have to think about that. You have to read it and understand it.
And to almost counter that, Jeff, because I think debt at times can be seen as a bad thing. Like it's bad to have debt, but actually there can be examples where it can be a good thing. And let's say you've almost got, you need to buy something for £10,000, but you've got £10,000 in the bank. Are you better off right now investing that £10,000 and getting yourself in debt for the £10,000 purchase because of low interest versus what you mentioned at the start in terms of the markets?
I suppose I'm going to say it comes back to your own circumstances, doesn't it? And I suppose that's where it's really important to, as Laura said, Neil said, to take that consideration. What is the right thing for you to do?
Yeah.
And it might be that you actually need to get advice to understand, am I doing it in the right way? The markets offer you a return. They do certainly do that. Depends on your own circumstance whether it's the right thing to be saving more of that or getting that right balance between, well, actually I'll go and use some of that for a purchase, I'll take on some debt to do that, where it's right. There's things where you don't have the ready cash sitting about to go out and purchase a car, purchase a house. You may earn up for the deposit, but certainly you're not going to have the house purchase price sitting in the background. So there's circumstances where you need to do it, but there's also that circumstance where you're getting the balance between I'll spend on debt here versus I'll save here and earn that spread difference, if one will, to think about it. So if you can make 6-7% on investment versus your 1% in debt, well, there's a positive reason why one should be investing.
Yeah, for sure.
So there's just, I think it's very circumstantial dependent.
And you mentioned financial advice, Jeff. So Neil, you were talking about net disposable income being an important part of the financial advice package.
Yeah.
When an advisor sits down with a client and looking at net disposable income, what is there a quantum of it? Are we looking at a certain amount left over each month, or is it not as simple as that?
Well, it is dependent on circumstances, but it's a comfortable amount. So, if you had £2 left at the end of the month, we would say, you're just paying off your bills, but you really couldn't afford to put any money away. I think a lot of people, certainly under lockdown in the past 2 years, have accumulated a lot of savings, which is why I'm really surprised at things like Klarna being pushed, because you almost think that your average consumer doesn't need that sort of stuff because they've saved up money. But when we look at net disposable income, we look at how much you can afford, how much you've got free every month. Once all your bills have gone out, once your credit card payments have gone out, and as Laura was saying before, it's good financial advice to say that if the end of your zero rate is coming up, switch it to another credit card, because that's going to be zero and you're going to be paying it back. You're not going to be paying a high proportion of the debt back and wasting your money. But when we look at net disposable income, we say, how much have you got at the end of the month? Well, can you afford to put some money into an ISA? Can you afford to put more money into your pension? And is that going to leave you short every month? No, it's not. Well, then save for your future, because that money is sitting in the bank, and more importantly, you're not getting that rate in the bank. Is what you would if you invested the money.
And do you think, Laura, we should be doing that at the end of the month, like Neil says, or do you think it could be better to almost take it head on and get all your payments done at the start of the month and then see what you've got left?
Yeah, it's a good question, because I always sort my bills and everything out at the beginning of the month, but I think it may be a little bit daunting. So for people that are maybe haven't been investing and think, I definitely can't afford it, it may be, that you maybe, when you approach the month, if you maybe miss that night out or you miss that weekend away or whatever it is, you're saving that money. So at the end of the month, you think, actually, I do have that £100 or £200 or whatever it is. So I'll maybe put that, using the impulse save. It's very quick and easy, so that you're not almost approaching the month thinking, I'm already £100 or £200 down, and you're having to kind of maybe scrimp and save and not live the life that you wanted to for the rest of the month, but maybe switch it around and maybe say, right, I'm going to miss that one weekend away or whatever it is. So then at the end of the month you think, well, actually I have got that £100, I'm going to put that away, because now I'm going to get paid and I'm going to start again next month.
As Laura says, it can be frightening at the start to look at that, but it's probably the right thing to do, to take a real cool hard look at it at the start of the month. My salary's coming in, these are the payments that I need to make, and just doing it, and then getting a real clear view, a clear picture of on where you stand.
I think a good practice, sorry Dan, I think a good practice is, we always talk in financial advice, is if you're going to save, treat it as a bill. And when I set a payment up for my council tax or my mortgage payment or anything like that, it's always, when do you want this coming out? And it's always the first of the month. I want it coming out on the first of the month, because you have them couple of days when you see everything coming out your bank and you go, God, I've left, I've got that left for the rest of the month. But if you've got £50 a month direct debit set up to go into, say, your true potential ISA or your true potential pension, within 3 or 4 days, that's gone out. You're going to treat that as a bill. And I treat all my investments as a bill, to say my £400 a month, which is going into my ISA, that is a bill and that is an expense. And then once you track it, you see how it's growing, you realise the importance of treating it like a bill. And it's good budgeting, it really is.
I think when you're used to that as well, it's kind of good advice. But I think for some people that's maybe not used to investing and not used to that bill, and treating it like a bill. It's almost just dip your toe in and have a go and
just get in the habit of it, Laura.
And that's what it is. It's habitual. You know, you're now in the habit of, well, that's a bill to me. So it just comes out, and then you know what you can afford.
Yes.
If some people are maybe not used to saving, or they're not really sure how much they can afford, just dip your toe in, make that kind of first step.
I think that's the good thing with probably as direct debit as a mechanism as well, because once it's set, it just happens. Yeah. So before you get, it's a bad couple of days, because you get the end of the month and Laura, you and the team pay us, so it's like, look at the bank, and then the next day, because I'm the same, it just all goes out straight away. But it's direct debit, so you're not thinking about it, and you feel, I think everybody does, when a new expense comes out, you feel the pinch, don't you, for the first couple of months, 3 months or so, and then I think you settle down, and you get used to that then again. And I mean that's a good point, Neil, because it's, your mortgage is a bill, your car payment's a bill, your credit cards are. Why shouldn't your ISA or your pension
a bit like auto
be the same?
enrollment?
Yeah,
you almost don't even notice it. As soon as you get into that habit monthly, you kind of don't miss it because you never had it. And it's a good kind of practice to get into.
Yeah. And it gives you a really good, forward looking to the rest of the month to say, this is what I've got left. All my bills are out. This is what I can afford to impulse save. This is what I can afford to maybe put into my account, which is, it's just going to sit there in the bank. So it gives you really good practice moving forward through the month.
So these are obviously positive ways in which we can deal with debt and deal with also investment on the other side. Laura, if we maybe look at a more negative side of things, I'm aware that not everybody's maybe in the same fortunate position as what it sounds like us four are, where we've got spare cash to invest. At times, and we talked about this with some of these less kind of nice firms, we'll use the word, where they can get people heaped under tons of debt there. Is there a type of strategy we should be advising people to do when it comes with dealing with large debt, which is almost wiping out all of their income and just to manage a debt or service a debt? Yeah,
absolutely. I mean, in my younger days, I was definitely in that position. When you kind of have your first job and it's, I've got this money, and we were talking before, Jeff, weren't we? It's, when you get your first overdraft or your first credit card, it's very easy. And with all these kind of, high street lenders, and it's almost, I think when you get a little bit older, you kind of think, well, I can't really continue life like this. Yeah. And I remember when I was younger, I got into that, maybe early 20s, you get into that position, and you maybe kind of consolidate your debt is maybe a suggestion for me. Consolidate, so you haven't got, I've got to worry about that, I've got to worry about that, and it's just one lump sum payment that you need to gradually pay off over time, and then again, kind of once that reduces, you then get more favourable rates maybe.
So did you have multiple, like a store card here and a car or what have you, and you just put it into one?
Yeah, when I was younger, so you maybe have a bit of an overdraft, you had a credit card which you were paying interest on, which I would never do these days. And it was almost just a bit overwhelming, I think. Well,
it can be easy, certainly when you're younger as well. I'll use myself as a selfish example. My first job when I was 18, I got £9,600 a year, which was £800 a month. So, and after about 6 months, I went and bought a car and the insurance, and the car was £320 and the insurance was £60 a month. So before I knew it, half of my income, gross income, was spent on this, and it was just a ridiculous thing to do now. But and I had to do what you did in the end, which was kind of suck it up and get on with it, know that it's a short-term thing, but not kind of double down on that debt, not to support, say I had £400 left, it'd be very easy then to go and get a credit card and to add into it.
That's the real challenge, isn't it? Because it's going to flip one of both ways. You're either going to double down on it or you're going to address the problem. And I suppose that's where it's really important to take a cold hard look at it and say, actually, I need to do something about this, and not try and close it off into one of those other compartments that we can do at times. It'll sort itself out. It certainly won't.
No.
When we know the rates that are involved and it gets into a situation that's unmanageable,
Jeff,
quite quickly.
You can see these circumstances where individuals do, and it gets untenable incredibly quick.
I think there's also a physical attraction to assets. So if you think, I'm going to get that new car, I'm going to get that new MacBook, it looks really nice, that novelty soon wears off. And then what you're faced with is the reality of the monthly payment. And you're thinking, it's going to take me 3-4 years to pay this off. I've got a 3-year-old laptop that I'd rather have a new one. But you realise you saddle with that debt. So I think it's judging really what you actually need. I do need a car to go to work. I might have a nice car to go to work. I do need a house to live in, a mortgage, etc., etc. And it's looking at really just trying to save up for those things if you've got net disposable income, rather than just taking it out on debt.
Do you know anybody who bought a MacBook who didn't need one?
No, not
No.
at all. Not at all. I've been promised one,
Yeah.
but I've never got one, not yet.
Yeah. It's a little in joke there, I think. Everyone thinking, what's he talking about? Obviously, Laura, you've talked about that with some debt. I've talked about my car. Neil, Jeff, any sort of what would be your worst experience? What's the worst way in which you've got yourself into debt?
I think very very similar to Laura when you're just starting out in the job.
Yeah.
There's lots of things that you want. There's lots of things that become really easy to get with a card.
Yeah.
And you just, I'll have that and I'll get that and I'll get that. And before you know it, actually there's quite an amount there that you're looking at. But the thing that I think I suppose got me many years ago thinking back was just rates of interest were very different than they are today.
Yeah, yeah.
And when you think about, we think about 25% as the APR potentially in cards today. It was a lot higher many years ago, and it really brings it home. It's like an additional tax on the cost of buying something. So I suppose, ironically, if you think about it in that way, am I willing to pay, so I don't know, say you're buying something at £200, am I willing to spend £250 in that?
Well, that's it.
Probably not.
Yeah, and I think the consumer would be better protected by giving a real example like that, Jeff, because I once got a Top Shop card as well. That was the same sort of thing. But actually, unbeknown, because it's somewhere hidden away on page 20 of the terms, was a high exit penalty as well. So if you cashed the thing in early doors, you got stung.
I think that's a good point.
So
I think that's a good point. A lot of people pay £50-60 up a month on their credit card or a bill, and they don't realise how much of that chunk of that £50-60 is actually just paying off the interest. And it could be as much as 25%, and you're looking at it and you're thinking, God, it's not going down much, I'm not paying this off, because they don't realise they're on those rates. So having a look at how much you are actually paying from an APR point of view, consolidation, going to a 0% credit card is all good practice. To get your foot off that sort of debt ladder, if you like, and get yourself back on an even keel.
And just think about the interest rate that you get in the bank on your savings. That that has to be your frame of reference for this. So if you're getting 0.1, but you're getting charged 25. It's quite a big spread there. There's somebody's making some money there somewhere. And it's because you're having to pay that.
Yeah. Also, from a financial advice point of view, when we're giving advice to the clients at True Potential, we're looking at how much money you've got to spend every month, but you're looking at the fact that you can actually put money away. If you've got debt and you're paying it off, good, great. If you can't afford to pay it off all at once, fantastic. Put some money into your investments, and then you've also got an investment pot as well growing alongside the debt that you're paying off. So mixing it, it's not to say that you have to just immediately pay off the debt. We would like you to pay off debt as quickly as possible, but you can afford to invest even at a smaller amount as well. And also, more importantly, keep yourself an emergency fund, a rainy day fund. That's always really important. If you've borrowed for something, but then something happens to the boiler.
That's where you see the short-term debt come in. That's where you can see people get into bother, which is the boiler breaks down and they don't have £1,000 there to buy the new boiler. You pop it on the credit card, you then miss moving at the 0%, the interest rate kicks in at 25%, and it just starts compounding up.
And your wage is gone.
Yeah. So it's you typically recommend 3 months?
6 months we do now. We do a safety.
Yeah,
it used to be 3, but we're going for 6 from a sort of a safety point of view, and we're saying got £1,000 worth of outgoings every month, keep £6,000 as a rainy day fund, because actually if you think of £6,000, it is a lot of money to me and everybody here, and it's a lot of money to most people. However, the price of things, it just goes straight away. And you're talking about a boiler, Dan, which is £1,000. Probably, £1,000 minimum. You know, you've got other stuff on there as well that would probably bring it up to.
It's been a long time since I bought a boiler.
50s, So it's, you know,
need ones.
and look at your price of cars.
Yeah.
You know.
It's the maintenance of cars as well, isn't
Correct.
it?
Yeah. So yeah, good point.
Yeah. Well, I think we talked about mortgages at the start, which I think is probably likely to be most people's listening and most people in the room's largest debt within there. You've got different repayment vehicles when it comes to servicing that debt. You can have the full repayment, so you're paying an element of interest, but also an element of the actual capital amount down. So say it's a 25-year mortgage. At the end of the 25 years, you've serviced the interest, but you've paid off the loan. Or versus an interest-only side of things where you, as the name suggests, you pay the interest only at the end of the 25 years, you owe the amount. I know it's not financial advice before compliance get worried, but what strategies are you three employing when it comes to servicing your mortgages, and do you feel that's the right strategy? We'll start with you, maybe, Laura.
Yeah, of course. So yeah, I think, you know, how long have I had my mortgage? Maybe 5-6 years. So I was probably a bit late onto the property ladder. And again, I kind of went with a repayment mortgage, you know, to try and almost get that loan to value down. You get a better interest rate. It's actually quite stark, the initial rate that you get when you're a first time buyer. I maybe got like a 2 to 3 year fixed, and then when you shop around, the interest rate almost halved because I'd been repaying rather than just having that interest only.
So the actual amount you then needed to borrow
Correct.
was
It was advantageous for me, and then you get to that point, you almost assess your financials and say, okay, well, I was paying X amount before, I can afford X amount, it's now reduced to whatever it is. Should I then maybe, you know, should I overpay on the mortgage because I could afford that before? Do I then overpay, or actually do I put that in my ISA, for example?
Yes.
And that, I think that's a big question for everybody.
It goes back to what Jeff was saying about probably circumstances, but probably also particular appetite for risk.
Absolutely.
So I suppose the difference to what you would do is, I don't know, let's say your mortgage costs you £1,000 a month, £500 is for the interest, £500 is for the capital payment. If you just paid £500 for the interest and invested the £500 a month into an ISA for 25 years, would it outstrip it? And I'm sorry, I'm not looking at you for the answer, Jeff.
There's no right answer.
Yeah.
But I think if we think about individual circumstance within that, your tolerance for risk on the investment side, but you're also your tolerance for risk on the debt side, and how that feeds into your overall thinking about your finances. There is that opportunity to, with your mortgage, to have those different pots of money. You have your debt pot, but you have your pot that you could manage to grow that, to pay it off at the end of the time. And then striking a balance, well, maybe I'll grow some of it, but I might contribute a little bit more to my mortgage, particularly if I'm thinking about remortgaging. Reduce that LTV, move to a different rate, and certainly shop around for those rates, because interest rates are exceptionally low. So mortgage rates by definition should also be much lower. So if you can get a rate that's really attractive and it works for you, certainly if there's a 3-year fix or a longer term fix, it's all things that should be considered.
I had a terrible experience that when I bought my first house in Gosforth. It was when Mervyn King was still the governor of the Bank of England, and he said interest rates are only going to go one way. This is when they were about 3.5-4%. They're only going to go one way, which is up. So I fixed my mortgage for 5 years at 4.5%. Being sensible, nice repayment one like yours, Laura. And then we actually had the banking crisis and everything from there. So still lament the day for being sensible.
That's the interesting thing. We've got rates that in a historical context are so low. So that's why it is really important to think about what you can and can't do.
I mean, you've got a cheap rates at the moment. You know, you can get a tracker mortgage from 0.95. You know, extremely low borrowing on a mortgage.
Well, would it be fair, Neil, if we stay on you and we stay with the cost from there? So you're saying you get a variable rate for less than 1% at the moment. Would you say it's a fair assumption that not everybody, but a number of people who have an interest-only mortgage have no repayment vehicle for it, and what they're hoping to do is service the interest and then in 20 years' time or 5 years' time sell the house and hope that the price of the house has gone up enough to write off the loan.
Yeah, that's probably what they primarily thought when they took that out.
Yeah.
Thinking to make the increase in house prices would ultimately pay off that mortgage at the end, and they would only service the interest side of it. So yeah, definitely.
Yeah.
And that was definitely in people's minds when they were taking those out. The worrying bit is that I've seen, where we've seen some horror stories that people quite rightly don't have those repayment vehicles in place. And a good mortgage lender should always suggest that, because you need something to go alongside it, because when it ends, you need to pay off that serviceable, that debt, that mortgage debt. So yes, there are. I mean, most people will be on repayment mortgages. Be the payments too high, maybe they can't afford it, but are living on the limit. But what Laura said is a good point. When you do take out your first mortgage, you're always going to be paying higher. If you're paying that 5% or that 10% deposit, you're always going to be getting that higher mortgage rate because you're a first-time buyer. When you get down and you've paid off some of that debt, then you can shop around and you can say, well, my loan to value is a lot smaller now, I'm going to get a better rate. What does that do?
Yeah.
Well, that creates net disposable income for you at the end of the month. And then you can look at your finances and say, whoa, I've got some spare money at the end of the month now. I can put some money away. But yes, I mean, interest only, probably not an avenue that I would go down, because I like to know that, yes, in the first years of the mortgage, you are paying off the interest, and then you start getting into the repayment part of it, the actual debt. And that's what I like to know. I'd like to know at the end of that term, that mortgage is paid off.
I've got one other kind of fear, and again, it's maybe unfounded or not, that there's, because of what Jeff was saying, we've had this historic period of low interest rates, where people have these interest rate only mortgages, and they're on the limit in terms of their net disposable income.
Yeah.
They're paying just enough to service at 0.95 or 0.5 or whatever it is. And all of a sudden the Bank of England does creep things up 1, 2, 3% or whatever to a more typical sort of interest rate. I think this could push people over the edge when it comes to the debt, where all of a sudden their outgoings are higher than their incomings.
And I suppose that's back to what Laura was saying at the start, in the spreadsheet or your bit of paper to write it all down, get a sense of where you are. If you don't have that flexibility to move, if interest rates do move a little bit, you want to be aware of that. You don't want to suddenly tip yourself over the edge.
It's a great kind of unseen threat, I think, and I think we've probably got a generation or two now. The rate's been low, Jeff, 2007, 2008?
Since effectively then we saw rates move up in 11 to sort of 13 a little bit, and then obviously cut last year back to emergency low levels. And I suppose the real challenge there is, where could rates go to? We talk about individuals, we're talking about individual debt here, but we're also got a situation where governments have got a lot of debt.
Absolutely.
And there's the two dynamics there. So rates might move up. They probably should move up given where we are from an inflation perspective.
I think
it should feed through to rates. We saw, interestingly, last week, if you look at the back of the Sunday papers, you see a lot of the really cheap rates. But then over the past 2 weeks, a lot of those have gone. Now they've moved up a bit, but the really ultra cheap, less 1% rates have gone.
I think what we've also seen in the last, certainly in the last 6 months, Dan, is the stamp duty, being on houses. And I'm not saying this was the big con, but it was, people were very influenced to buy houses because of the fact that there was no stamp duty on these properties. However, what people didn't realise is that house prices in general were £20,000 more than they were last year. So people were maybe looking at it saying, oh well, a lot of buyers are attracted to buying a house. We're going to put that money, the sellers, we're going to put that money on the front end of the house. So in real terms, you're paying that £20,000 on the front end of the house of the price over a course of a repayment mortgage, which means you're spending even more rather than saving that initial stamp duty, which you have to pay up front. And a lot of people were attracted to that. And I think with regards to what you said before, Dan, if those house prices are £20,000 more and you've borrowed on those, what happens? And people are up to the limit on their net disposable income. What happens when then property prices fall and they're in negative equity from a mortgage point of view over 2 or 3 years?
Or you can't sell the house, which you also see with some of these new buildings, but they've been doing the help to buy mortgages. I've got a friend who's got one and hasn't been able to sell the house for 5 years. Because because he lives on an estate with another 100 houses, exactly the same, all at exactly the same costs, with the same mortgages, you know. They're effectively trapped, so to speak.
Of the original price that they bought them in as well, which was higher. So it's it'll be an interesting couple of years, and I think from a mortgage market point of view.
Sounds a bit doom and gloom, doesn't it? I'm not sure how to pick it up. I'm not as talented as a host on the podcast. This is where Peter Boulder make a silly joke.
Yes.
But look, let's finish with, you know, maybe a top tip from the three of yourselves. Have we got 3 good tips in us? We'll start with you, Laura.
Okay, that's fine. My top tip, again, you know, my spreadsheet. It does help. It almost gives you an overview. You meet people and they don't know what their income is. They probably know what their income is, but they don't know all of their outgoings. Get comfortable with what's coming in, what's coming out. If you need a spreadsheet, get a spreadsheet. I recommend a spreadsheet. But again, it just gives you that oversight and planning as well. You know, look ahead to the next 6 months, 12 months, or whatever it may be, and plan your goal. What can you afford if you've got the debt? How are you going to repay that over the next 12 months? You know, if you're saving for a house, when do you want the house? When do you need the deposit for? Unless you get into the detail of your comings and goings, you'll almost never get there. The goal ends up moving further and further away. So my top tip would be kind of get into the detail of your comings and goings and then start planning.
Jeff?
I think for me it'd be about understanding the small print. Where something might look optically attractive, nothing is a free lunch. There's always something at the back end of it, so understand it. Don't just accept that it says 0 or it's an exceptionally low rate for a period of months. What's the true price? Do that little bit of maths in the background and say, well, if it's £100 and the rate's 20%, it's going to cost me 20% more. Would I pay that normally? And if not, why bother?
Neil?
Quite simply would be, don't borrow to buy if you can afford to. I think for the smaller stuff, I said it a couple of podcasts ago, if you don't necessarily need something, then, you know, save up for it if you're going to buy it. I think that's a really good, important thing. And regularly review your outgoings and we, like Laura said, we all know what we get paid, but stuff comes out your bank every day. I mean, if you go on your online app, it's like £2 here, £3.20 for Starbucks, and it really does build up at the end of the month. And I'm a big sort of sinner where it comes to going to Starbucks for a coffee, and I should just come to work and get one. And I'm saving myself.
Charging.
And I'm saving.
Stop billing,
Let's just go with that down.
And I'm
Put
saving
a little bit.
I'll put an expense for but £3.20, it does build up. Going to Sainsbury's for something else, it builds up. And when you look at actually how much money you're spending on groceries every month, and from a budget point of view, you're thinking, I'm spending a fortune here in Sainsbury's and groceries. And
I think that the overriding theme really from all 3 of yourselves is take some responsibility and manage it. Take responsibility in keeping an eye on your incomes and outgoings. Take responsibility in understanding what you're getting into, Jeff. And the fantastic point which you make, which is if something costs £200, but it's going to cost £250, would you still pay £250 if you had that cash in your pocket for it? And I know it can be tricky to figure out that small print, but I think we're in such an interesting environment now with the internet, with calculators, where if you're not sure, stop and research it online, crunch it, ask somebody from there. And Neil, again, probably linked with Jeff's point about would you pay £250 for something which is £200. It's the same if you're buying a consumable item, which is, would you pay £200 for that?
Yes.
Do you need that right now? Or is it worth saving up for
Correct,
the
yeah.
2, 3, 4 months there?
Yeah.
And it's I know it can sound a bit preachy and a bit boring, but I think what we're hopefully trying to get across, ladies and gentlemen, is this idea that if you can get your net disposable quantum correct, you can have a fab life, you can have the debt, you can manage the debt, but importantly, you're leaving enough set aside to buy the consumable items, to be able to invest into your pension, invest into your ISA, or what have you, and get that balance correct. I think it's a rare event when you see somebody with no debt whatsoever. Debt unfortunately is a bit of a
Right.
necessity at times.
Yeah.
But as is investing for your future
Yes.
from there. So futures, we've got the weekend coming up. Neil, what are your grand plans?
Well, I went to my owl sanctuary last weekend.
Oh, yes.
So that was interesting. So I haven't got anything as exciting this weekend. I haven't been in Newcastle for a while.
Right.
So I might go and visit our favourite men's shopping
Well, I was going to say,
clothing
last
shop.
time you were in Newcastle, you bought the same coat
I
as
bought
me.
the same jacket.
did
as him,
you?
yeah.
Yes,
So
true
I'm
story.
going to go
With
and
cash or with a card?
debit card, yes, or cash.
Oh.
Really. Electric cash, electronic cash.
Yeah.
Not
Yeah.
debt.
No, not debt.
And had you saved up for it?
I had saved up
Yes.
for it. Yes. All the money I saved
Yeah.
in the lockdown.
Yeah.
So, so I'm going to go into Newcastle. I'm going to go into Phoenix for my breakfast. I'm going to have a wander around and a bit of shopping because I've not had a bit of shopping done for a while. But nothing exciting, just Newcastle town centre.
Are you going to wander along Phoenix window?
Yes, yes I am. Yes, I am. Phoenix, yeah, that sounds good.
Jeff?
Probably some rugby at the weekend, building on last week, so continue to watch some of the autumn internationals there. And then an unexpected trip up to Edinburgh to get a new car windscreen. So one of those things where you've had to save for.
Yeah.
Had a bit of a...
Was it an emergency fund?
It'll be an emergency fund.
Yes,
Hopefully the insurance emergency fund will step in.
Well, that's it. It's normally £50 excess,
Yes.
isn't it, for a windscreen? Yeah. Laura, are you going to beat a trip to Phoenix or a windscreen
I haven't got
replacement?
anything too exciting, but I think I'm going out. My sister's home from Dubai,
Oh,
so
good. Yeah.
I think we're going to head out with my sister and my mum at the weekend, bit shopping, maybe something to eat and a few drinks, but nothing exciting.
Because when you were last on the podcast, you
Yes.
ventured into Newcastle as well.
I did.
This must be something for people from Durham where it's a big day out.
Well, the last time I think it was we'd gone for bowling and karaoke, so that was a little bit more entertaining.
Yeah. Did you get up and sing in the end? Because you weren't sure.
Well, we actually in a small room. It's a pretty dark room with all the lights and stuff, and everybody kind of sings along. There's only 2 mics. But I didn't get on the mic. I think that was a bit
No.
too far for me. But everybody sings along. It was good fun.
Yeah. Did you have a favourite karaoke song, Neil?
I don't do karaoke. My singing is terrible, so
Yeah.
I think I would blow the machine up.
And Jeff, I know that you're too sensible to do karaoke.
If you'd heard me sing, you wouldn't have done karaoke.
It sounds like something all 4 of us have got in
Yeah.
common. Yeah. Well, fab. Well, look, Laura, Jeff, and Neil, thank you so much for contributing today. And ladies and gentlemen, thank you as well for listening and for tuning in. I hope you found it useful. I hope you've hopefully picked up a couple of strategies and a couple of top tips as we progress. Certainly as we go into the end of the year as well. I think that's something we maybe should have touched upon as you get into the Christmas period. Don't get yourself into these huge amounts of debt as well, ladies and gentlemen, but probably a subject for another day as well. So thank you, everybody. Have a lovely weekend, and we'll speak to you next week. Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.